Japan's 10-year bond yield surged to 2.23% earlier this year, signaling the end of the zero-rate era and testing APAC Bank's resilience. To expand on this is Harumi Taguchi of S&P Global Market Intelligence and Tetsuya Yamamoto of Moody's Ratings. Harumi-san, welcome. I'll bring you into the conversation first and ask you, what factors triggered this sharp rise in Japan's 10-year bond yields?
There's two factors behind the high JGB yields. The one is monetary policy, and second, the fiscal policy. The Bank of Japan has gradually raised its policy rate since March 2024, in line with the changes in corporate behavior regarding pricing and wage increases driven by inflation, labor shortage, and changes in economic conditions. Bank of Japan also concerns about the impact of the yen depreciation, more importantly, fiscal policy changes. Sanae Takaichi was elected as the Prime Minister last November, and she calls responsible and proactive fiscal policy is leading to the spend more key policies such as the promoting investment to the growth in sectors. This intends to ensure fiscal stability by steadily lowering the ratio of outstanding debt to GDP, but the market concerned about the supply-demand condition due to the rising issuance bonds amid BOJ's tapering bond purchasing. The LBB pledged to suspend the consumption tax on food and items for 2 years, but the funding sources are not clear yet. So these developments are fuels the market concerns about the fiscal deterioration.
The rise in Japan's 10-year yields reflect a combination of three factors. One is policy normalization, and second is inflation, and third is global repricing of duration risk. First, the Bank of Japan has fully exited its yield curve control, allowing long-term rates to be set by the market for the first time in over a decade. That alone fundamentally changed supply-demand dynamics for JGBs. Second, inflation in Japan has proven more persistent than expected amid wage growth and higher import costs. That has pushed up inflation expectations. And third, higher global yields and persistent inflation risks mean investors now demand higher term premium to hold long-dated JGBs.
Harumi-san, why is this being described as a structural regime shift? Quite strong language.
Japanese yen has been the key currency for the territory for a long period. The external, the domestic investor has borrowed yen in the low interest rate and invested the high yields foreign currency denominated asset. The investors will need to change this investment strategy in line with the high Japanese interest rate. As rising yield clears to all that attractiveness of Japanese government bond, the investors could sell foreign currency denominated asset and repatriate to Japan. Since Japanese investors is one of the largest holder of foreign government bonds, the capital flow could be increased volatility in the global financial market.
Yes, it is called a regime shift because Japan has moved from an era of administered interest rates to market-determined rates. For nearly a decade, the Bank of Japan suppressed volatility through negative rates and yield curve control. That framework is now gone. Long-term yields are no longer capped, and inflation expectations are structurally higher. This means interest rates are no longer a policy variable, but a market signal. And both investors and financial institutions must operate in a world where rates can move sharply and stay higher for longer.
Thank you. Now, Tetsuya, while I have you on camera, in your opinion, which markets in Asia Pacific are the most vulnerable to spillover risks?
From a Japan-centric perspective, rising domestic interest rates have the potential to affect Japanese banks negatively through reducing asset values by weakening the value of JGBs on their balance sheet. However, the recent sharp increase in long-term JGB yields is manageable for Japanese banks. The average duration of Japanese megabanks' JGB holdings is around 1 to 2 years, so their interest rate risks are limited. On the other hand, Japanese regional banks' interest rate risks are higher than those of Japanese megabanks because of their longer bond duration and relatively large bond holdings. However, regional banks have reduced risks by shortening bond durations and reducing bond holdings. Regional banks' average bond duration is 5 to 6 years. Although still longer than the megabanks, they have very limited exposure to super long-term JGBs. We expect Japanese banks' profitability to improve. Net interest margins will widen as domestic interest rates rise, while a shift of cash holdings and maturing JGBs into higher yielding ones gradually lifts their asset yields.
Thank you very much. Now, Tetsuya, I'd also like to ask, how prepared are Asian banks for a prolonged higher rate environment?
From a Japan-specific perspective, there is a clear divergence. Japan's megabanks are well prepared. Their interest rate risks are limited. They have diversified earnings and strong capital positions, allowing them to absorb mark-to-market losses on JGB holdings. In contrast, smaller regional banks in Japan are more exposed, with relatively longer duration of 5 to 6 years of their JGB holdings. Having said that, Japanese regional banks have a large base of retail deposits, which reduces the risk that they would need to sell their JGBs in a rush. About 60 to 70% of regional banks' yen deposits come from retail clients. As a result, banks would be able to hold JGBs until they mature. And even though unrealized losses would increase as interest rates rise, those losses would not be realized as long as banks hold JGBs until maturity. Liquidity or deposit profile changes.
Harumi-san and Tetsuya-san, thank you very much for sharing your thoughts with our viewers today.
Okay.
Thank you very much.
Once again, our guests were Harumi Taguchi, Principal Economist of S&P Global Market Intelligence, and Tetsuya Yamamoto, Vice President, Senior Credit Officer at Moody's Ratings.